ladies and gentlemen, this is Brian. Thank you for joining me today at Bitcoin Summer. Today we're going to be talking about whether you should pay your mortgage off or not. And this goes back to a previous episode of good debt and bad debt and what are the differences between those two. And I needed to expand, I realized, a little bit more on that concept as to why exactly should you keep your mortgage. And as I mentioned during an intro a couple episodes ago, I had an interesting conversation with my brother-in-law, and it ended up being really good, a really good outcome. And he ended up not doing extra payments towards his principal with his mortgage payment. And I was pleased because I've also had conversations with friends that have not gone that way, and they are sticking to their guns and keeping or starting to accelerate their payments on their mortgage as they gain more cash. And today I'm going to do a presentation on why exactly that is not a great idea financially. There could be other reasons why, but financially it's not a great idea. And I did actually wake up today shocked at the price dropping so much. We had a little bit of a recovery towards the beginning of the week with the Evergrande situation, which I covered last episode. And now we had this great recovery and this run back to, we dropped right around 41,000, and then we had this great run back above 44,000, and now we're back right around the 42,000 level. And I was surprised, and I went and found out what's going on, and apparently China has banned cryptocurrency, and they've banned Bitcoin. And this is about the 30th or 40th time that they've done it. And it felt like Groundhog's Day because it felt like waking up in May when they did the same thing. And it ended up being a lot of bite and not a ton of bark back in May, because they did end up essentially outlawing Bitcoin mining, although there is a lot of hash still coming out of China. So I'm not quite sure if there are some firms that are still allowed to do it or what's going on over there. It'll be interesting to see how it all shakes out, but I just had to laugh and also buy some more Bitcoin because this is the time to do it. The fundamentals haven't changed. They actually have gotten better. Twitter unveiled yesterday that now you can tip people using the Lightning Network through Strike, and I've covered Strike on this show as well. It's amazing because you can even tip somebody cash. You can tip somebody US dollar, and they won't even know that it's running on Lightning, on the Lightning Network, on Bitcoin. And you can receive cash, and you can either keep it in cash or switch it into Bitcoin or whatever you want to do with it. But even with people that don't believe in Bitcoin or don't want Bitcoin, they're going to have to use Bitcoin. And it's going to be very easy, and it's going to be very inexpensive to send payments over Twitter because of the Lightning Network. And this is only going to exponentially increase adoption. And so, if anything this week, the fundamentals have gone up while the price has been a little weak. And these are always, in any financial market, these are always the best times to buy. This is how you find inefficiencies in the market and you exploit them for your benefit. This is how the wealthy and the powerful have been doing it since day one. And to not be purchasing today, or not to be purchasing at all this week, means you're not fully committed. You still have a little bit more work to do as far as figuring out whether China banning Bitcoin is signal or noise. And I do have information for you all. It is noise. And Brandon Quittem, actually, who's a good guy, he's a Minneapolis Bitcoiner as well as I am, and he's put out a tweet earlier today, about an hour ago, and says, historically a great day to buy the dip, and he put out this chart. And sure enough, May 21st is the last time China banned Bitcoin, and the price was 37,174. Gone up 15.5% since then on an annualized rate that's 51%. November 22nd, 2019, China bans Bitcoin. Bitcoin price 7,748. Move since then 454% or 153% annualized. Let's keep going. September 3rd, 2018, 72.79 price of Bitcoin. Price move since then 489%. Annualized 79% per year annualized. This goes all the way back to 2013. $1,153 Bitcoin. China bans it. Move since then 3,623%. It's 2013. Still an annualized rate of 59%. Unbelievable. China banning Bitcoin is always a time to buy. So be out there buying. And so I'm going to jump right into the episode right now. Like I said, we're going to be talking about why to not pay off your mortgage and what does that have to do with Bitcoin. And in fact, we're going to be going through all of the different scenarios if you were to keep your house or keep your mortgage, keep your loan, and what you would do with that cash that you would be using to spend on paying off further principal payments or paying off the house. And we're going to compare that to the opportunity cost of getting that mortgage payment off of your back. So that's a positive, and a lot of people see it that way. Like, I don't have a mortgage payment anymore. But we'll find out during this presentation why the opportunity cost is better for keeping that cash available for yourself right now. So without any further ado, it is chilly out there today up here in the Midwest, northern part of the country, and it's turning into fall for sure. Finally, it's been kind of hot the last couple weeks, but in here, it's always Bitcoin summer. They price this out of the housing market. They price this out of the education market. They price this out of the stock market. They continue to price this out of day-to-day goods. We need to take this back, and this is our time to do it. Okay, so let's jump right into the presentation here. As I said in the intro, why you should never pay off your mortgage. And never is a strong term, but I wanted it to stand out a little more. I will go through at the end why there could be a couple reasons why you might want to pay your mortgage off. But we're going to be talking about math today. If you have an aversion to math, I've broke it down very simply. If you have any questions, please contact me. You can find my email on the website, and you can find all of that information in the show notes. But if I go too fast, just let me know. I'm here to help. I'm not here to make this complicated. And I've broken it down as simply as I can, but sometimes that's even too complicated for some people. And I know that sometimes I work a little too fast. So I'm going to try to do this as succinctly as possible. So let's start working our way through the slides here. So should you pay off your mortgage? Now, the way I see it, there's 3 levels of understanding to paying off your mortgage or not. And I think each reason is a better reason than the last. And the reason why you should hang on to your mortgage. And the biggest one to me is, the biggest overall reason is none of these reasons, but the biggest overall reason is the interest rate is so damn low right now. And if you can borrow at that rate, you hang on to that forever. You don't pay that off, because we will find out why. So a novice level understanding of why to not pay off your mortgage is the mortgage interest and rental income deductions. And I'll go through these in much greater detail. The intermediate level reason is the opportunity cost that I mentioned in the intro. And finally, the third is the master reason. You have become the master. The apprentice has become the master. And that reason is because of inflation and money printing. So let's move on here. So the stats on home ownership. Now these are the downfalls, I think, of owning property is you have to pay property tax. So you hold something like Bitcoin, you don't have to pay property tax, obviously. You do have to pay capital gains tax, but that's only when you sell it, and I'm not selling mine. So I have found a way to not pay those taxes. And there are other ways to create income off of that, or not income. Sometimes you might want to just take a loan from that if you have US dollar needs, but I digress. At this juncture, we're going to be talking about owning a home. And the property tax rate across the country, the average is 1%. And, that's kind of similar to owning like an ETF. If you own an ETF, you're paying a management fee, and they've got those pretty low. Actually, it's usually a lot less than 1%. They've got them really, really low. But for instance, something like the Grayscale Bitcoin Trust, which is not an ETF, it might be converted at some point, that is 2%. So each year you're paying 2% on your holdings. And you don't see that come out of your holdings. They do it on the back end, and they're selling Bitcoin for it, or however they function that. Now, the federal income tax brackets, this is going to come in handy for level 1 understanding of why not to pay off your mortgage. The tax brackets are almost $20,000 to $81,000. That's the 12% bracket. And then the $81,000 to $172,000. And I'm rounding these. It's a little bit more exact than that, but you get the picture. Now, the 30-year fixed mortgage just yesterday was 2.88%. This is because I have talked about, and I talked about in depth last episode, the U.S. government, not even the U.S. government, the Federal Reserve is printing a ton of dollars to pay off their own treasuries. And what this does is push down the risk-free treasury rate. And a lot of interest rates are coupled with that risk-free rate. And so there's a premium on that, but the simplest way to put it is the reason why these 30-year mortgage rates are so low is because of money printing. And I have a chart here. Freddie Mac, you can see in the 1980s, it was above 15% to buy a home, to get a loan. And you can just see it. It's programmed to debase, just like our currency. I mean, the interest rates are just plummeting since the 80s. Just absolutely demolished. And these are not free market rates. These are controlled rates. So think of that what you will. The annual historic return of the S&P 500, 10%. So that has to do with our opportunity cost, and we'll go through that in a little bit. So level 1, to be a novice in finance, the easiest benefit that you can foresee with owning a piece of property and keeping your loan is to understand the mortgage interest deduction. So all of the interest that you're paying to the bank is deductible, up to $750,000 loan. Excuse the plane going overhead. I hope that's not too loud. So all interest paid can be deducted from your income, like I said. And, this amount is not going to be completely life-changing. But the way I always look at it is every little bit helps. And so when I get these extra boosts of a tax return or whatever, like whatever financial little magic that I performed, if I save a little bit of money here or there, I put that straight into investments. And the way that my investments have been stacked the last year plus is all in Bitcoin. So all of my savings and all of my tax deductions and all of my returns, all of that goes to Bitcoin. So that's just one way to look at it. And like I said, if you're earning 10% on it on the back end and just putting it in a simple ETF, a 10% S&P 500, you're earning 10% on your S&P 500 ETF, it's the simplest way to do it. So all of that money is risk-free because you didn't have that money before. You created that out of some accounting trickery. So this is all getting a little above our pay grade as far as tax planning goes, and I'm going to jump into a little bit more about tax planning down the road on the show. But just suffice it to say that it's in your best interest to use all of the money that you save and coupons that you use or anything, all the money that you save should be put towards investing. And that is if you're out of bad debt. You want to be out of credit card debt. So just that's a little caveat to that. So with the tax brackets that we discussed, it's $12 to $22 for every $100 that you spend on your interest per year. So an interest payment of $5,000 a year, that'll equate to $600 to $1,100 per year. So like I said, put that into investments. So the drawback is if you don't itemize your returns, it's basically a wash. And sometimes they'll incentivize you to not itemize, and it also makes it easier and it'll be above what you'll actually earn. So it is kind of a wash because you do get a minimum of a deduction. So, but if you have a large mortgage up to $750,000, that's a good way to do it. Itemize it. So an argument I hear with this one is, okay, but I'm not paying that mortgage payment every month, and I can use that money every month. It's like a raise so your mortgage payment is basically added onto your income because it's not coming out of your account. So that's true. I totally agree with that. So more benefits, and there are a couple more, but like I said, this isn't life-changing stuff here, but let me go through them. If you generate rental income, your interest expense offsets it. So I live in a duplex. My wife and I bought it in 2018, and we rent out the other half. Now, if I didn't have those interest payments, if I paid off my mortgage, I couldn't write those interest payments off against our rental income. We would have to pay taxes on that rental income. So that's a huge, huge, huge benefit for us. And so if you're in that situation, you definitely want to take advantage of this. And you can also, if you do have a rental property, you can deduct the depreciation expense, but that's for another time. So, you can still do that if you pay off your home. So that doesn't really pertain to this conversation, but I just wanted to bring that up as well. So, and another bad thing about paying off your mortgage is that your credit rating goes down. It doesn't seem fair, does it? But that's just the way and the world that we live in, and we got to play by their rules, unfortunately. So let's go to the level 2. This is the intermediate opportunity cost. Little bit deeper understanding of why to not pay your mortgage off. So if you use your saved cash to pay off your house, what you're doing is you're missing out on the opportunities that are right now in the open market. Or if you wanted to invest in yourself, if you wanted to start a business, you're missing out on that opportunity. You're using that money to pay the bank, and you are not allowed to use that cash anymore. You are not allowed to move that cash around or allocate it. The bank is now. You've switched ownership of that cash. It's a very bad thing. You reduce your own liquidity. Your options are taken away. And you're doing it while you're ditching a very low interest loan. Like I said, 2.88%, if you have a really good credit rating. So let's run those numbers. So let's say this is your mortgage. You got a $300,000 house. You put 20% down. That's $240,000 in principal. That's a 30-year mortgage, let's say at a 3% interest rate. Now, this is the sticker shock for people sometimes. the $124,000 worth of interest payments over the life of the loan. Yes, that's pretty daunting. And this is what people get stuck in their head, because they will look at their mortgage printout and they'll say, oh, I'm going to be paying $124,000 over the life of this loan. You forget that that's over 30 years. If you make $50,000 a year only, that's 3 years, and you have 27 more years to make up that difference. So people get that. I would say it's a definitely a unit bias, and they see that number and they are just physically repelled by it. So this is why people pay off their loans early, is they see that number and they want to get rid of that. And I understand that. But let's look at the benefits. So I have option 1 and option 2 right next to each other. So with option 1, now I just did it in the case of your idea was to just pay off the loan, right? So obviously this is a simplified version of it, because you're not going to pay off your loan with $240,000 day one of your mortgage, but it's an illustration of the opportunity cost of money. And my alternative in fact, for both of these options, I have decided to plow all of that money into Bitcoin for either option. So let's just say you're a Bitcoiner, but you want to pay off your mortgage in option 2. And in option 1, you want to... I'm sorry, I have that... Yes, in option 1, you have immediate use of that $240,000 and you put that all into Bitcoin. Now, Bitcoin has been returning right around 200% year over year since its inception. But that's probably not sustainable, because that's coming from a very, very, very low price. So I did kind of a degrading return on it. So I put, and I did it for the same for both option 1 and option 2. So I didn't favor either one. It's the same exact degrading returns. So, because let's say this, like after 20 years passes and the price stabilizes a little bit, it's not going to run from 10 million and do a 200% from there. It mathematically, that's so many trillions of dollars that it's just not possible. So it does make sense to me that it will be a degrading annual return every year. And so I've handicapped this quite a bit. So what I started with, first 10 years, 40% return. The second 10 years, 20% return. And the third 10 years, 10% return. And so option 1 is not paying off your mortgage. So in 10 years, you almost have $7 million. 20, almost $43 million. And the total amount of money you would have over a 30-year period in this scenario is $111 million. Did I say 1,000 before? What I meant was 43 million. I might have said million, but let me make it clear. A 30-year return, not the profits that you would make, but your total money at the end of 30 years from that 240,000 is $111 million. Now let's take a look at option 2. Like I said before, you're going to have this income swing, so you're not going to be paying that mortgage payment. So I worked it out, and it's only going to be $1,000 payment every month for your mortgage originally. So that's a nice income. That's a nice bump on your income for sure. $12,000 a year is not nothing. So this is another reason why a lot of people pay off their mortgages earlier, because they don't want to have that $1,000 payment every month. And I get that. But look what happens with this money. It's a good return. So you're taking that $1,000 swing because, now that's above and beyond your income, right? So that's what I do. I just put that into investments. So if I put that into Bitcoin and I did this degrading return schedule, 10-year, 1.5 million, 20-year, 11 million, 30-year, 31 million. It's a great return, but 31 million compared to 111 million, It's apples and oranges. So you can see here, the second level, the intermediate level of understanding, it's pretty clear. It's pretty clear. And this goes with anything that you do. So you can go back to my example of earning 10% on an S&P 500 ETF per year. If you dollar cost average in, you can use the same exact numbers and just use 10% a year. And you're still going to have that much magnitude of more money if you put that $240,000 in today. And that goes with any amount of money. So let's say over time, let's say you had an extra $10,000. It's the same thing. You can use that right now and invest in it right now instead of paying it off to the bank, and then they have control over it and they get to make investments, and that's how they make money. So you're taking the power and you're taking the cash back into your hands. That's the way I see it. So let's move on to level 3. This is the master level of finance, and this is where the money printer goes burr. And so this gets even better. This is where it's completely mind-blowing. Inflation benefits borrowers when we have low rates, when we're in a low interest rate environment. Inflation will benefit you as the borrower. Think about it this way. You signed a contract to pay your loan with a nominal amount of dollars. You don't pay back the loan with the value of those dollars at the time of signing. If you declared that you're paying them back $1,000 a month, you're going to be paying them $1,000 in 30 years, in 25 years, in 20 years. And the simplest way to wrap your head around inflation is think about when we were kids, or I'm kind of dating myself here, but 25 cents for a can of Coke. And then even about your parents, when they were talking about a can of Coke, or it was a bottle back then, a bottle of Coke would be a nickel. I mean, that's the simplest form of inflation, and we just have rampant inflation right now. And, I don't even know I don't drink soda anymore, but I don't even know what a bottle of Coke costs anymore. But it's an easy concept. It's a little bit more difficult to wrap your head when you're considering, because it's easy to, the money that you're shelling out, it's that everyone knows prices go up over time. But it's way more difficult to wrap your head around the money that you owe and how you benefit from inflation with low interest rates. So here's the stats on inflation. The historical rate of inflation since the year 2000 is 2.21%. But there's a caveat to this. This is based on CPI numbers, and I have briefly talked about it on this show before, but CPI numbers are complete garbage. You don't add in there shrinkflation. So that's, the amount of the thing that you're buying is getting smaller. So the ounces or the grams or whatever of the thing that you're purchasing gets smaller, but your price stays the same. It's a way they sneak in inflation. It's kind of like if you think about it, our savings accounts back in the day were right around 5% interest. I mean, that's unbelievable right now. And just slowly they chip away at that. That's kind of what this is. It's a slow chip. Shrinkflation not taken into account. You're not taking into account any investment vehicles, stocks, which have been just... So the normal person can't buy stocks at a normal cost. The inflation has brought those up completely, and that's not included in inflation numbers. Home prices are not included in inflation numbers, real estate. They call it something like the rental equivalent. So if you own a home, they call it rental equivalent, like what you would be paying in rent. It's a completely bogus metric. They don't take into account that houses have gone up by 20% this year. Historically, it's like, I think 2% or 2 to 3. I'd have to look at those numbers, but it's not 20, it's not 15, it's not 10. I can guarantee you that. So the last 2 months, and again, I'm going by CPI numbers, so take this with a grain of salt. The last 2 months, it's been 5.4% inflation. No signs of slowing. So historic rate for the year 2000, it's just over 2%. It's now 5.4%. The average inflation this year has been 3.67%. And these are using bogus numbers. But we do have to address the elephant in the room, and that's the M2 money supply increase. And that's what I refer to when I say money printer go burr. Now, what is the M2 money supply? That is the Federal Reserve creating money out of thin air, literally hitting a computer key and printing that money and putting it out into the system. And banks have instant access to that, and they can loan that out and make money off of it. And the whole system is completely rigged. And I have this chart here again from the Fred, and 8% year over year since 2008. So since the financial crisis, we have seen money get printed at 8% rate. And the reason why I wanted to talk about M2 money supply is brilliant minds, much more brilliant than myself, Lynn Alden, Michael Saylor talks about this as well. They assert that they argue that the inflation rate is actually the money printing rate. And I buy into this quite a bit. And I think our inflation rate, our real inflation rate, is actually, it looks more like the M2 money supply rate, the rate that we increase dollars in the system. So like I said, 8% since September 2008. 17% in the last 2 years. Look at that huge spike up in 2020. Look at that. That's a parabolic climb. And you'd think it'd be tapering off a little bit, but now they kind of got themselves in a bit of a bind, and it's not looking like they're going to be able to back out of this anytime soon. So when we're doing our calculations on this expert level financial class, so let's be conservative. We always want to be conservative in our calculations because you want it to be realistic, and you don't want your biases to play out. You don't want to make investment decisions on bias. And so you always want to be conservative. And let's just say that the Fed is somehow able to tame this inflation beast. Let's just say they get things under control. I don't think it's going to happen. But let's say they do. We'll use the inflation rate of 10%. So we want to see what our $1,000, from our example before, our $1,000 mortgage payments will look like going forward into the future. So here is our loan payments, and these are the values into the future. And as you can see, our loan payments are programmed to decay exponentially over the years. So what I did, I went side by side. I went 2%. Let's just say it goes back to the historical average. The inflation rate goes back to historical average. I don't think that that's possible, but let's say best case scenario, it does. It goes to 2%. In your last year of your 30-year loan, your $1,000 payment, it's $559. It's worth you have $559 purchasing power with that $1,000. So you're actually paying them $559 in today's dollars in 30 years. Now, obviously, look what happens when that inflation rate goes up. 6% in 1 year, your $1,000 payment is only worth $955. In 20 years down the road, it's only worth $316. Now you're starting to understand why you don't pay these loans off. Your $1,000 payment is only in 20 years is only worth $316. Now let's do what's more likely to happen, especially within the next couple of years, is an inflation rate of 10% if you're looking at the M2 money supply. In 1 year, it's only worth $920. So already in a year, you think about it like an investment that's earning 10%. a loan is like earning your interest rate by keeping it. If it's really low, it's going to benefit you. The exponential decay is insane on a 10% debasement. And September in 2041, your $1,000 payment for that last 10 years of your loan is only worth $150. And obviously that goes down a little bit, but you get the picture. That's the payment in September in 2041. It's $150 purchasing power of that $1,000 payment. The last year is the best. Your last couple payments are going to be under $100. Insanity. I mean, you want to be paying those back at those nominal dollars. That the $1,000 is worth less than $100 in 30 years. That's pretty crazy. Even if it's 6%, in 30 years, that $1,000 is only worth $176. Even if it's 2%, that $1,000 is only worth $559. I mean, you got to hang on to your loans. So I'm going to wrap it up with some reasons why just people don't want to keep their mortgage. They want to pay it off. And this is perfectly fine, but never tell me that it's a financial reason. Never tell me it's an economical reason. It's always something else, and that's fine, but it's never a financial decision. So a good reason to do it would be you're nearing retirement, and you just want to get the monkey off your back, so to speak. So by paying it off, you can just be done with that. You're out of debt. You're nearing retirement, you get all of your debt off of your back, and you just ride off into the sunset. That's a really good reason. So another reason is the philosophical reason. And, that's when we're talking about self-sovereignty, especially financial self-sovereignty. You want to decouple yourself from the banking system. You just have an opposition to debt, just fundamentally. I get those reasons. It's like I said, it's never financial. It's never an economic choice. But for some people, the economical choice is not always your top priority. And that's fine, and you need to make that decision on your own. So with that, we're going to close it out. As I said, it is fall here in the northern Midwest. It's getting a bit chilly. It's getting a little bit colder. But in here, it's always Bitcoin summer. I'm your host, Brian. I will see you next time. Thanks a lot, peeps.